Welcome to Do the Talk podcast. Here at Do the Talk, we teach regular people like you how to invest in real estate. I am your host today, Ibrahim Ojerinde, and my co-host is Ahmed Lawal. We are committed to make real estate investment seamless as much as possible. So if you would like to learn and grow with us, you have come to the right place. Ahmed, how are you doing today? It's another Friday.
Yeah, it is another Friday, Ibrahim. It is an exciting one, indeed. And, just like we promise, we always deliver. And today is going to be another fantastic episode. You don't want to miss it. In fact, I would say if you have anyone that missed this episode, please and please copy the URL and send it to them, because this, as let's push real estate to the side. This is something you will need in every of your daily life activity. Tax is everybody's problem. So
Yes.
without further ado, we always say on this podcast that we are regular people just like you, and there's nothing special in this than this is a proven path.
Yeah.
And you don't have to be genius, you don't have to be this is not rocket and science. This
Yeah.
is real estate. You can make it work. You just have to play by the rules. Well, today we have always tell you guys like, okay, real estate have one of the greatest, tax benefits, in the entire tax code, right? But
Yeah.
we have always mentioned that we are not CPA. Consult your CPA. Guess what?
Mhm.
We have CPA on the show today. Someone
Yeah.
that have the in-depth knowledge of how tax, real estate, stock, normal tax, income, and just name it. Someone that have done it all. We always deliver, and this is another one that you want to stay glued to your screen
Yeah.
until the end. I am talking in person of Alaja Taiwo Agbaji. She is a owner of TRA CPA firm in Austin, Texas, and she has over 18 years of experience when it comes to taxes, accounting. You're gonna love this episode. Don't let me uh over deliver before she come on stage. So meet our guest today, Alaji Atayo Agbaji. How are you doing today, man?
Good evening, guys. Good evening. I'm doing well. How are you doing?
We are doing
We're
fantastic.
fantastic.
Thank you for joining us.
Thank you for having me on.
So I always call her Alaja. I haven't verified if she has been to Mecca yet, but that's what I called her. Anyways, before we dive into the business of the day, I want to really ask, who is Alaja Taiwo Agbaje? And how do you kind of come into the space of accounting and uh, taxes, in general? Just in few minutes, just tell us who you are so that we can go ahead with the
Yeah.
program.
Thank you for having me. My name is Taiwo Agaji, and I am a CPA. I try to call myself, I like to call myself the tax monarch or tax strategist. And that's because I work with taxpayers and real estate investors. We do have a lot of real estate investors. I work with them to help them strategize so they can legally pay the least amount in taxes without breaking the tax code. In terms of where I began, I've always wanted to be an accountant. I know way back from Nigeria that I've always wanted to, be an accountant. I was in the commercial class when back in Nigeria we used to have this commercial science and art. So I was in the commercial class, and I remember that I I started having a passion for accounting because I had a very good accounting teacher. He's of blessed memory now, but he was the one that really gave me a very good background with accounting, and that's how I got to love it so much. And I've been in the accounting profession here in the United States for more than 10 years now. I started my career back in Nigeria, and when I came here, because of the struggles I had in getting a job, I had to obtain the CPA license, and that was how I got into working with small businesses, individual taxpayers to help them save on taxes. I have worked in corporate America. I have about 7 years of experience working in corporate America, and then 2 years ago was when I completely transitioned into running my firm full time. I'm very passionate about real estate. I'm also an investor myself, and I speak a lot with real estate investors, and particularly for those that are somehow new into the industry, and also those that are W2 employees that want to get started, they want to have some portfolios, but they do not understand the tax impact. So I'm more like the back end CPA or tax person for such individuals. And I'm happy to be here today to be sharing some of the things that I know to some of your audiences and see how we can, you know, help everyone achieve the American dream and financial freedom.
Absolutely,
Thank
absolutely.
you for that.
Sorry, Ibrahim, I'm gonna give it back to you, but I am so itchy, it's itching me in my body right now. I just have this so much question that I want I want to ask because this is a big topic, right? So we on this podcast we always talk about how beneficial real estate can be when it comes to taxes. I want you to please start us up with, if you are to pick the best three uh tax code when it comes to real estate, what would that be?
So when it comes to real estate, so the tax code that is very important that everyone should know is the IRC 469, and that's the passive loss limitation, right? That's the code that talks about the passive activity loss limitation, and that's because for real estate investors, a lot of people want to get into real estate. Oftentimes, particularly for our income earners, when they are coming into the industry, they feel like they can, from day one, they can utilize the real estate to save on taxes. However, there is a tax code that is the Internal Revenue Code 469 that talks about the passive activity loss. And what does that mean? It tells us that what that code specifically says is that passive losses can only be offset by passive gain. So if you have a W-2 employment and your goal is to utilize real estate to save on taxes, unfortunately, there are certain rules um, that would prevent you from taking advantage of those benefits that you desire. And the code that the code that affects your ability to take advantage of that is that passive loss activity. And what it says is that so for W2 employees, your employment, whether it's a W2, whether it is a business owner, you are a business owner or you're a self-employed individual, your income is a non-passive income. So generally, your income, everybody's income is divided into passive income and non-passive. So the non-passive income are the W-2, business income, self-employment income, and all of that stuff. Now, when you are in real estate is passive income, is naturally a passive income. So for tax purposes, most people are going into real estate because for tax purposes because they are trying to accumulate losses from their real estate portfolio, so they can use those losses to offset or reduce their taxable income in their 1040 tax return. Unfortunately, because of the passive loss limitation and rule, they cannot offset losses from their real estate investment because it is a passive loss. They cannot utilize it to offset their non-passive income, which is W2. So that's the first thing that everybody needs to be aware of. That I know that a lot of people are not are oblivious of that fact. is that when you're going in, just know that you might not be able to utilize your real estate losses to reduce your tax liability if you have a high income that exceeds the active loss income, or you are not a reps, you don't qualify for the real estate professional status, and we can get to that later on. But that's the most important code that I feel like every real estate investor should know. Everybody should know before they get into real estate.
Absolutely, Ibrahim, go ahead.
Yeah,
Ye-
we appreciate you for breaking that down. So with what you just explained, I mean, it's kind of personal that you cannot just type up. Also,
I
um,
think your mic is kind of breaking up. Okay, Elijah, the same thing on your side, right?
Yes, I heard it. Your mic is breaking up.
how about how about now?
Yes, it's a
Yeah.
lot better now. A lot better.
Okay. All right. I okay. I said we really appreciate you, breaking that down to us, and I'm sure we understand very clearly now that when you try to invest in real estate, you have to um, understand that not everybody will be able to get that non-passive and passive. I mean, it's your job, so you know how to really help people navigate that. But I have a question on still the same topic. Um, will this affect someone who is actively involved in that investment? Like someone who is really actively involved, because it seems like there are certain hours that if you dedicate into that your real estate investment, that helps you to qualify for some deductions. Is that
Yes,
correct?
absolutely, absolutely. So there is active participation, and there's also material participation. Those are the two key participation types that you have. Now, there is also the $25,000 um, allowance that you can take if your income does not exceed $150,000. So for W-2 employees or anyone out there, if you have a non-passive income from your regular income, you are still able to make use of your passive losses from real estate if you have actively participated in your real estate activity. Now, that 25,000 limitation has a threshold, and the threshold is that once you earn your modified adjusted gross income gets to $100,000, the $25,000 begins to decline until you get to the $150,000 where you don't qualify at all. And when you look at the caliber of people that invest in real estate, a lot of them are high income earners. So usually they might not be able to qualify because of that income threshold. So that's the active participation. And what do we mean by active participation? It means that it's a lower, when you compare that to material participation, it's a significantly lower threshold to me. So active participation means that you are actively involved in, say for instance, you have a short-term rental, you're actively involved in getting your guests in, you're actively involved in screening guests so that they can, before you onboard them onto your property, you're actively involved in looking for cleaners and all of that stuff. So that's active participation. It's a lot easier to qualify for that. Now, when we move past the active participation, then we get to the material participation. That's the most difficult one, and that is when we begin to talk about the 750 hours for real estate. So before you can qualify for real estate professional status, you have to, number one, you have to be able to you have to work in real estate activities for 750 hours, and then you also have to work in real estate activities more than any other activity. So for you to qualify, now I'm moving a little bit towards the real estate professional status, which is the reps, right? So for you to qualify as reps, I used to say that reps is the gold mine of real estate, because that is when you can utilize everything. You can just take every benefit of real estate in taxes. But for you to get that rep status, you will have to meet two important criteria. That's in addition to material participation. The two criteria that you have to have 750 hours in real estate activities, and then you also have to work in real estate more than any other activity. So that means that if you have a W-2 employment or you have a business, if you have worked in that business or W-2 employment for 1,500 hours, you will have to work in real estate activities for 1,501 to qualify for the reps, right? Now, if you don't qualify for that, you do not qualify for reps, and you cannot make use of your losses from real estate. Now, even though you're not making use of those losses, you don't lose them. Those losses are still available for you. They are suspended until two or three things happen. Number one, you qualify for reps in the future. Those losses will be released for you to use, or you dispose of the assets. Those are the two criteria that you can utilize your losses if they've been suspended. So it's a case of you either take the advantage of real estate losses now, if you're a rep, where you can use it right now, or if you don't qualify for reps, you have a long-term benefit. You don't lose it; it gets suspended. You can use it anytime in the future when either of those two activities occur. But those are the key aspects that. And I hope I answered your question on
Yeah,
hours.
you answer. Yeah, that's a great one. I mean, it's pretty clear to us now that there are tips and tricks, and there are some other information that as an individual or a new investor we have to, and that's why we have to come close to you, the CPA, so you can guide us on how to navigate and be legally qualified for all these tax breaks.
Yeah.
So I want to follow with this answer because it's very broad, and I want to make sure people get more clarification. So it still sounds to me that with all the education you just passed to us now, is that even if you are not a real estate professional, it doesn't mean that you don't qualify for anything. It's just that there are different grade and different or tax breaks that might qualify for a person A, and it might not be okay for a person B. However, there's still a way that some can, depending on your situation, you might still get tax break just because real estate taxation is robust. Is that what you are trying to tell us?
Yes, you're right, and that's because everybody's tax situation is different. So I tell people that you don't compare your taxes to your tax situation to someone else or to your friend, right? So everybody's situation is different, and when you look at the structure of how taxes is how the tax code is structured, you realize that people that have been able to invest in activities that the government wants the citizens to invest in, they are able to reap a lot more benefit from taxes, whether it is real estate, whether it is any other kind of investment, whether it is oil and gas or any other alternative investment. There are certain incentives for those individuals. Now, even though as there are those incentives, there are also limitations to a lot of them. Almost every law, almost everything in the tax code has a limitation, and those limitations comes about through income, where certain people can qualify, certain set of people may not qualify. And when you look at, so for instance, even as we're talking about the real estate, reps and qualification, an individual that is married, whose wife is not working, the wife is a stay-at-home mom, they might be able to qualify for, the wife might be able to qualify as a real estate professional if that's the intention, because she is not working, right? So she can easily qualify because obviously all of activities will be involved, will be in real estate, right? Now, when you compare that to someone that is, that both husband and wife are working, right? There are two different tax situations when you look at it from real estate perspective, because the family that does have the wife that is not working and is actively involved and managing all the real estate portfolio of the family can easily qualify for reps. And once the wife qualifies, the husband also qualifies if they are filing jointly. So their tax situation is different from another person that is both husband and wife are working W-2 employment. They cannot get the same benefit like someone that has a spouse that is not working and is working full time on their real estate portfolio. So this is just to tell you that everybody's situation is different, and it is not a cookie cutter approach. It is also the reason why it's not advisable to take an advice from social media and run with it, or take something, listen to something on social media and just run with it. No, that's because what you're hearing from social media might not work for you based on your unique situation, based on the structure of your family, on a lot of things that that the person communicating to you on social media might not have privy to. So you have to always consult with a professional before you implement any of those strategies that you hear on social media.
Absolutely. Thank you so much. This has been the hottest 23 minutes we've had on the podcast so far. And thank you. So, before I ask you the next question, I want to mention to our audience, please and please, if you have a question, let's make sure we drop it in the chat, in the comment box, or anywhere you are watching from. If you have any comments or chat box, drop it in there. That will come directly to us, and we can answer your question. Alaja can answer your question live here before we leave today. So my next question will be, a lot of time, just like you just said, we have all these gurus on YouTube, on Instagram, doing 30 seconds video and telling us this is real, you got to do this, blah blah blah. I just bought 75,000 car. I can write it all off from my, my. How does that work in a real sense? What are the caveats? What are the things you need to meet to be able to write off all these? Oh, I bought this vehicle, now I'm using it for my real estate investment. How can I write it off?
Okay.
Because all this 30 seconds video doesn't elaborate on anything. They just throw it out there and they run away, which is why we have this podcast, right? So please,
Yeah.
can you kind of shed more light on that?
Yes, absolutely. So, generally, for a business, for an expense to be tax deductible, for an expense to be something that you can deduct on your taxes, it has to meet certain criteria, which are it has to be necessary, it has to be ordinary and necessary for the business. It also has to be reasonable. And when I mean necessary and reasonable means that necessary in the fact that, so for instance, real estate investors, you guys are going to need a car because you're not going to walk to your properties, right? So car expenses, vehicle expenses are a necessary expense. But where the reasonability comes is where, for instance, you cannot say that you took your client to for lunch and want to claim maybe $20,000 for meal expenses, right? That's not reasonable. So that's where you also have to be thinking about, does this pass the common sense test, right? We see that a lot where people want to claim, something that is outrageous, and I'm always like, no, this doesn't even. I mean, my 8-year-old can really tell me that this doesn't even make sense. So you have to also look at the reasonability of the expenses. Now, when it comes to expenses generally, particularly for real estate, yes, you can take vehicle deduction, car deduction, and all of that, but there are strict rules to that. And IRS actually audits that. That's also a red flag for IRS audits. And generally, for you to be able to take car deduction or vehicle deduction on your business, you will have to keep track of your mileage. In all cases, almost all cases, you have to keep track of your mileage because you can only deduct business use expenses. All personal use expenses are not deductible. So if you have an asset that is mixed personal and business, you will have to be able to determine the business portion of the use of that asset so that you can deduct the business portion. You cannot deduct anything personal. The same thing goes to so like you mentioned you can deduct $75,000, go buy a car, you deduct everything, write everything off. That is not how it works. So for vehicles are what we call listed assets. So aside from certain vehicles that are above 6,000 pounds, those are the vehicles that last year, and that was last year, right? We have something that we call bonus depreciation. So bonus depreciation allows you to take 100% of tax deduction. So if you bought an asset for a car for $100,000, and that car exceed £6,000. Yes, bonus depreciation, you could take, do an 100% bonus depreciation and deduct everything at once. But if that vehicle does not meet up to that standard, it is a listed car, it is a listed property. You cannot deduct the full amount. There's a cap, there's an excess amount that you can deduct. Now, even though you can deduct a lot in the first year, the other undeducted amount will still be spread over a period of time. So where you can still deduct them, but the goal is that you cannot deduct everything in the first year. Again, this is also going back to social media where go buy something, you can write it off 100%. That is not how it works. It depends on the size of the car. It also depends on bonus depreciation. Last year was 100%. This year, 2023, it is 80%. But there is a law that they're trying to change that to 100%. The bill is still yet to be passed. We're still waiting on that. But the goal is that, in summary, yes, there are a lot of deductions, but they have to be specifically for business expense, for business purposes. They have to be reasonable, and they also have to be able to um, corroborate those expenses by keeping your invoices, your receipts, and everything that will help you win in the event of an audit.
Ibrahim, do you have any?
Oh yeah, that's a good one. I when you mentioned that you have to, you know, you have to work certain hours in, you do more of real estate, and I started feeling like, oh, okay, this is a good one for me, because I'm 100% focused on real estate. I said, okay, that means it's a good news for me. Anyway, so thank you for everything you have shared. I mean, it's very informative, and we have learned. Even our audience, Mr. Sakala, is very he has been consistent, and it's one of our awesome audience. He has been responding and saying, oh, he has learned that income tax code, is different, because a lot of people don't know that out there, which is why me and Ahmed, we are very happy that you are shedding light into this, because W2 is different, the real estate investment is different. And you telling us that in some situation, yeah, you might be able to, but we need to know, which is talking to an expert like you, so that you can know how you are going to do it, not just jump into that business, or even when you're in the business, talk to a CPA, and someone like you will shed light into it. Anyway, I want to follow up with the last one I just explained now. So what about if someone, you know, you last year, let's say you have talked to another CPA, they've done your taxes, and you kind of feel like um, your mileage or the kind of deduction they gave you is not um, something you think you should have getting something more than that, or even something, or you are just feeling like the CPA did not do it the way you are expecting. So how do are you guys so how do I ask this question? Okay, my question is that, are you okay taking a taxes that someone else has done and review it and kind of see, how moving forward that investor be can leverage, maximize his taxation, where he or she will not be losing, because we know that, you know CPA, some people know these codes more than, and I have full confidence in you. So my question is that, are you okay looking at people investment and try to see how you can make it better, and so that people can um, you know get the most out of, not just leaving out some money for the IRS unnecessarily, the legal way now. So how how can you go about that? Are you okay with that?
Okay. Yes, so that's a good question because we've seen that a lot where those that where people have come to us from another CPA or maybe a non-CPA or an unlicensed tax professional, and they've come because they feel like, oh, there's something not right on their tax return. So when they come, usually one of our check is to make sure that for all new clients that come to us, that we review their prior year tax return. It is a compulsory requirement to work with us. And that's because when we do that, we're going through your prior year tax return, looking at every missed opportunity that could have been taken for you, and seeing if there's any necessity to do an amendment. If we feel like the savings in doing an amendment is going to help you, we will recommend that you amend that tax return. And amending a tax return doesn't necessarily mean that you're opening yourself to audit. It just means that you're trying to correct some things on your tax return and getting more of your money back. So we do amend tax return. And going forward, usually what we do is that even when we prepare your taxes, we look at everything. What should have been done better? What are the missed opportunities for the current year? And then we also look at the next year and say, okay, what are particularly for those that have invested in our tax plan, we do ask them questions about what their plan is for the year and in the future. So we're looking at opportunities of saving them on their taxes, whether it's through the real estate strategies or through any other non-real estate strategy. And yes, we do amend, and we can always guide people on whether it's necessary for them to amend or not, and looking for strategies to help them save towards their taxes on an ongoing basis every year over year. So yes, we do that.
Thank you, Alaja. It looks to me like the time is running so fast today. I don't know why. Maybe because you are dropping a lot of bombs.
It's because we are
So
enjoying it. It's
before
because
the
we are
time we run
enjoying
out
it.
of time. Yeah, that is. It just look like it's been 34 minutes already. I don't know. So I want to. So we have an audience, Damola Oluomo, that has a question. His question is basically like, okay, people that do flipping, buy a house, they didn't hold it for a long time, just flip, renovate and sell, or people that do arbitrage Airbnb, where they don't own the property themselves, they just rent it, furnish it and rent it out. I kind of bring those two together so you can address it together. His question is, what are the best way to save in that regard? They don't actually own the property.
Yeah.
So that's it's kind of, if you own it, it's on your name, then you can use it on your taxes, but now you don't own it. So what are the way to save on taxes? That's one. Another thing is there any suggestion you can give so that they can know now it's still March and prepare for next year on how to save? So it's two-part questions.
Yeah, yeah, that's a good question. So for those that are short-term real estate I mean, whether it's short-term, whether it's arbitrage, Airbnb, or flip. So let me take it one after. So for flip owners, for flip investors, those that flip houses, they do not have depreciation, right? And so the way their taxes is reported is different. They are actually a non-passive investor, unlike a regular real estate. So their own is classified as non-passive. So, and as a result of that, they are also going to be paying self-employment taxes, right? Which a normal real estate investor wouldn't pay because it's a passive income. Passive income does not pay self-employment tax. Now, for those that are flippers, in addition to their tax, they're also going to be faced with self-employment taxes. So they, in particular, need to be very proactive about tax planning, about their taxes. And one of the, whether it's the flippers or the Airbnb folks, I mean, the most important thing is understanding your numbers, right? So because you really cannot plan if you don't know what to expect. You cannot be chasing a problem that is not there. But once you know that, okay, this year I already know that I'm going to do maybe 4 or 5 flips. I have a projected income. The number one thing I would say is to be aware of the estimated taxes. So when you are a self-employed individual, your taxes are due. The IRS wants you to pay your taxes in quarters. So every quarter you pay your taxes. Unlike a regular W-2 employment where your taxes are paid as you earn the money. So for flippers and any other person out there, you have to be paying estimated taxes. That's because you don't want to be surprised at the end of the year with a huge tax bill. So that's one thing. Being ahead of your estimated taxes. Then the second one is actually the tax strategy, which is that okay, now you know that you're going to owe a lot of taxes based on what you know. Then what can you do to reduce your exposure? Number one, um, loss harvesting. There's something called capital loss harvesting. That means that for those that are flippers, if you have shares that are worthless shares on the with your brokerage firm, if you invested in any stocks that you know they are worthless, you can sell those stocks so that you can have capital losses. So if you have those losses, you can use it to offset your gain. So you have to be looking at your investment in the stock market. Which of those assets are worthless? Which one can I sell for losses so that I can use those losses to offset my income? Now, even with that one, there's still a limitation where the maximum loss you can take in a year is $3,000, right? So any excess losses get suspended to the following year. You will still keep using the $3,000 every year until you've used it completely. But aside from loss harvesting, you can also um, kind of also do donation strategy. It's another thing. So donation is, and that's for you to do donation strategy, you have to be itemizing your deduction because you can only use donation when you itemize. If you don't itemize, if you take standard deduction, you cannot use donation. But now, once you know that, then your goal for the year will be how can I increase my deduction by utilizing itemized deduction? And so that's where donation strategy comes in. Are there any organizations that you feel like you can donate to, whether it's cash or even organizations that you can donate items of value to, like Goodwill, like any other organization that you can donate to? You also have to be doing that. And then, particularly for anyone, being able to maximize your deduction is one of the most underrated strategies, because I see people commingle funds with their personal and business assets and business transactions, and so they are always missing out on very important deductions, expenses that you can write off, right? So you have to be able to track all of your expenses as you are incurring them. If you don't have a separate bank account, you should have a separate bank account for your business specifically, so that even if at the end of the day you cannot remember that you paid someone for this transaction, once you know that all of your transactions went through the bank, you have some leverage that yes, everything went to the bank. So everything, all the expenses on my business bank account are all business expenses. I'll be able to deduct them. So that's another very good strategy. And of course, working with a professional. Yeah, that's a big one. You have to, this one is you have to really, really be working with a professional, and you have to be proactive. You don't wait till the end of the year. Tax planning is during the year, right? It is okay. It is during the year. Once December 31st comes and you've not done anything, unfortunately, there is so little you can do to save on taxes. Okay, so that's another thing.
Yeah. So quickly, thank you for that. What about, in a situation where someone, is or our partner, they're not sure about the exact, like you said, you have to know your numbers. But let's say this person accidentally overestimate or overstate their tax write-off, like instead of 2,000 you are putting in 5,000, you are putting this, putting that. What are the implications? What are the how can, or if it went to the south and they, how can somebody deal with that or maneuver out of that issue?
Okay. Yeah, so that's a good question, because we see that often also where when we review prior tax return, we see bogus deductions sometimes, and the question is always that, are you able to support this deduction, right? Even if anybody comes to me with taxes, once they bring, I mean, I don't have to see your receipt, right? But the question will be, are you able to, in the event of an audit, are you able to provide documents to support these deductions, right? And so if the answer is yes, okay, and does it look reasonable? Like, you cannot come to me now to tell me that you spent $30,000 on meals or something that looks outrageous. That doesn't even pass common sense test. I wouldn't even prepare that kind of a return myself, right? So that's one thing. And then so the disadvantages of overstating expenses are huge because now you're exposing yourself to audit, and then also you're also committing fraud in a way because you're cheating. I don't want to say cheating, but you're stealing from the government. Because no, doing that, you're risking your audits being audited, and then in the event that you're being audited, once all of those expenses are disallowed, IRS they are going to reclass those expenses for you, and they're going to recalculate your tax owed. They will calculate interest and penalty on it, and then you'll be forced to pay those expenses. That's even if you are not convicted of committing an offense that is a federal offense, which is tax evasion. So that's another thing. So it's and then also when you think about on the business perspective, I tell people if you don't want to pay taxes, particularly for business owners, they don't want to pay taxes. And so I always tell them that you have to think about the growth and your plan for your business. If you want to grow your business, you have to be comfortable paying certain amount in taxes. You don't want to pay more than necessary, but you should be paying taxes. And that's because when you get to the point where you need a loan, where you need some funding, nobody's going to give you is going to fund your business without a profitable business. If your business is not profitable, right? There's no one that will approve you for anything if you keep showing losses on your business, and if you keep, doing it that way. So you're also risking your business growth in a way. So there has to be a balance there for you. You should be able to balance both.
That was a very detailed and a fantastic answer. Honestly, I've never heard of lost harvesting. I think I need to do an amendment right now. I have I have some lost harvesting. I want to I want to
Yes,
claim
I
on my
did.
tax. So I that was a very big one in that your answer. And you see, we thank you so much. This time is running too fast for me. I think we will need to turn it back. So let me quickly ask this again from Donald Sakala. Can you um write off your down payment? Let's say you have a property before, you pull out some equity from that property and you use it to buy another one. Is that tax write-off? Is Can you use it as a write-off?
So it depends on whether that property is a the use of the property. If it is your personal home, right? If it's you're buying a property for you to live in, you don't get a tax write-off at all. So what you get is I mean, in the past there used to be a credit for maybe first-time home buyers, but right now you don't get a tax write-off. What you get is if you have a mortgage on that home, you can take mortgage interest deduction. You can also deduct your taxes. And also, all of those things, whether you're taking mortgage interest and taxes, is hinged upon whether you are itemizing. Okay. So now, if you don't itemize, you're buying a house, whether it's you're paying down payment or anything, doesn't save you anything on taxes if you don't itemize. Now, if you itemize and your itemization exceeds the standard deduction, now you can deduct your mortgage interest, you can deduct your mortgage point, you can deduct your property taxes. Those are the things that you get, and that's for a residential home that you're living in. Now, when it comes to real estate rental, if that property is an investment property, it's a different ball game entirely. If it is an investment property, yes, you can deduct. It's not the down payment now. You can deduct the costs of that property over. You're going to depreciate it over. If it's a residential real estate, it's 27.5 years. If it's a commercial property, it's 39 years. But you can also do accelerated depreciation using bonus depreciation. So it's entirely different. It depends on whether the property you're purchasing. If it's a rental property, yes, you can deduct. You can take a deduction, but it's not just the down payment that you're deducting. You can deduct the cost of that property through depreciation over a long period of time.
Thank you, thank you, thank you. I am loving this. Very, very good. Before I go to the next question, you mentioned something which is very powerful, and I don't know if our audience pay attention to that. I want to, just reiterate what you said. Um, you can file loss, but you also have to be careful filing loss, because you don't want your business to look like non-profitable, non sustainable business, especially when you want to get financing. Which I have a little story on that. I mean, we only have 10 minutes, but I've approached a bank before, and they look at my tax return like, well, it looks like you didn't make any money on your tax. I said, no, I made. But what I didn't realize is I paid taxes, but it was on my W-2. On my real estate investment, I wrote everything off, even to the negative. They was like, no, we cannot give you this loan on your business, but we can fund you on your W-2 income. But your business will not qualify, because your business is telling us that the investment is not profitable. So why would we invest in that business? I was like, okay, anyway, I got it. I'm gonna, like, just give me for my W-2. So I was able to get loan then. But yes, you are 100% correct. So it just came back to me, like, it resonated well, because it happens to me before. So, and I've learned from that. Now I don't, I try to stay out of that, show some profit, pay some taxes, because otherwise, it will bite you in the butt in the future if you are trying to write everything to zero, even though you know that your business is profitable. So I just say I should mention that we it's that's why you have to talk to a CPA, because what she's telling us today, nobody told me. It was because I actually ran into it. If I didn't go there, the banker would not tell me, and I might not know, and I'll keep writing off. One day, when I really need it the most, when I don't have a W-2 job, that is when I will now face the reality. And it might be when the deal is so sweet and juicy, and you'll be like, wow, why am I been doing this? So
Yeah.
I thank you for that, because yeah, I just want to mention that. So the next question, real quick, someone is saying ELOC. It's kind of similar to the previous question, but we just want to make sure we treat you help us treat our audience question. So ELOC, how, like, you get financing and you want to make it as a down payment. The person is asking, for tax purposes, what are the benefits, and can you write it off?
So for ELOC is home equity line of credit. So
Yes.
if you're taking an ELOC from your existing property to finance another home, a couple of tax considerations are there. So if you are financing, so that means that you're not gonna have two properties. The existing property will still be there,
Yeah.
and you're taking a line of credit out of that equity to
Yeah.
purchase another investment property. So the thing is, if the second property that you're investing it is an investment property, meaning you're trying to rent it out, you have to understand that for rental properties, again, the consideration of whether your losses are deductible is there, number one, and then can it be used for investment purposes as well? What tax are you able to? And then when you're doing ELOC, so as long as you're not selling your existing property, right? There is no tax consequences. You also, the only consideration you have to know is just the interest aspect of it, because now you're taking on a new loan a line of credit, which is, there's going to be interest on that, right? So those interests are deductible. You can still deduct that, but as long as you are not selling that property to buy a new property, you are not exposed to taxes in any way. Now, on the investment side of things, once you purchase the second property, investment property, you have to be aware of all of those things that we've been talking about how you can deduct your losses on as a real estate investor. And then one thing I also want to mention is that one of the things that we've seen often on tax returns for real estate investors is that we do see that sometimes people are not taking advantage of maximizing their deductions. Say, for instance, depreciation. The other day I was reviewing a tax return, and I realized that the clients had bought a property about 5, 6 years ago, and they never took depreciation. There were some also some expenses that were missing on that tax return. So you have to be aware of all of those things that you need to know, so that even if someone is paying your taxes, let's assume the person paying your taxes is not well versed in real estate, you are informed enough to know when something is not right on your tax return, when something is missing, and you can ask those questions. So for investment purposes, yes, you can do that. You can take ELOC from your existing property, but just know that you're moving into the realm of real estate investing, and those are taxed differently from your regular income. Um, yeah.
Thank you so much. We need to bring you back some other time, because we enjoyed today. I'm not saying we do not enjoy today, but there are some things that we do not touch. We need to go
Like,
back and do them. But real quick, before we kind of head towards closing down, I want to. You mentioned something about depreciation.
yes.
What is depreciation?
Okay. So depreciation is the um, gradual wear and tear of a property, of an asset. It doesn't have to be only property, of an asset due to usage or obsolescence or passage of time. So generally, in the IRS, and even when you were talking about accounting generally, when you purchase an asset, assets are usually purchased, they are usually high valued as items. So you purchase a car, a house, and things like that. So what depreciation does is that it allows you to deduct the cost of those assets over a period of time, where you spread it for a long time. And when it comes to real estate, it is one of the most important strategy for real estate, because that is what creates, we call it paper losses, right? We call it paper losses. And so that is what actually creates a lot of losses on the real estate, because they are not real losses. Those losses are paper losses. It's not like you're really losing money, because depreciation is a non-cash transaction. It's a non-cash transaction. So money is not leaving, there's no cash outflow, right? So it's a paper loss. And so because of that, for real estate investors, depreciation, taking advantage of depreciation is one of the most used strategy, because now we are now moving into the realm of bonus depreciation and cost segregation, right? So cost segregation, you guys may have heard of cost segregation, is where because you want to do bonus depreciation, now you have a property, and we are doing cost segregation because you and I know that if you have a property that is newly built, or even an existing property, you know that your carpet is not going to last for 27.5 years or 39 years. Carpets are usually depreciated maybe 5 or 7 years. So why depreciate carpet for 29 years when you know that in actual fact, by the time that carpet gets to about 7 years, you may need to replace it? So that's what COSEC does. They are looking at each property, each asset within that property, and saying, okay, how many years in reality, how many years does this asset is useful for, and depreciate, segregating your assets within that property into 7 years, 10 years, and 15 years, and then now depreciating those using bonus depreciation, where they can take 100%. So when you do that, you can now deduct all of those expenses at once. Like in the first year of the asset usage, you can depreciate everything at once. Then you now have just the structure and the asset that usually last for 27 years. Those are the ones that are left to depreciate for that long period. But depreciation is a very good strategy for real estate investors.
Um,
That's good.
thank,
Yeah.
sorry,
Go ahead.
Ibrahim. Let me kind of do this real quick. You see, I am talking through myself to our audience. So I mean, I'm talking to myself and our audience at the same time. You see, I always say something like, if you want to do anything in real estate, like you want to hire someone, hire an investor. Why do I always say that? If you hire a real estate agent that is an investor himself, he knows your pain and he knows where to come in and solve that problem for you. Talking to you tonight open my eyes into, if you want to hire a CPA, make sure he or she is an investor too.
Yeah.
Because everything you just listed, even myself that I'm claiming, okay, I invest in real estate, I'm this, I'm that. I learned a lot. That speaks something. That says that if you roll with people that are knowledgeable, they will not only sustain your business but expand your knowledge as well.
Yeah.
Another point is talk to a CPA because before you do anything. Just talk to a CPA because they will tell you how that thing will turn to a tax benefit for you. Lastly, Alaja, I really want to say this to your face. You just blow my mind. Your knowledge is so fast that you just blew up my mind. So I thank you so much for giving us this 1 hour of blessing. This is the finest 1 hour for me the entire week by far. So I'm not kidding. Honestly, this is really a fire episode. Everybody needs to share this on their social media page so that because this information can help people and can save life. Ibrahim, uh, sorry,
Yeah,
I just want to point that out.
yeah. You did a great job by pointing that out. I mean, um, I'm sure our audience are enjoying this. I'm loving it, and we want to thank the tax monarch um, for coming in tonight. I want to say something. So you mentioned that reach out to CPA before you do anything, which is a great idea. But I want to say also, if you're already into it, you still need CPA. The fact that you've started already, and there's no a better time to reach out to CPA. And I'm pretty sure she answered that question already. But I'm pretty sure she can review your taxes, and moving forward, she can take care of your taxes, making sure that you are maximizing on taxation. Because at the end of the day, it's not about how much you make; it's about how much you legally save.
Yeah,
The key word
legally
there.
safe.
Really, yes, that's the key word there, because of course you want to roll with CPA that will maximize all your profit legally, where you can sleep and don't think about IRS knocking your door and all that stuff. So it's very important. That was why I, repeat that legally. So how can they reach out to you? We are at the top of our years, 902, and we probably will try to get you back one day, and we'll give you give us the time that you can come in, then we'll find that time. How can they reach out to you? Either phone, DMs, or can you please, because I believe some of our audience would like to talk to you. Thank you.
Yes, definitely. So the fastest way to reach out to me, I'm also on almost all social media platforms. I'm actively on LinkedIn. I'm on Instagram. I'm also on Facebook. You can also email me at info at TRACP You can also email me at Taiwo at TRACP. You can also call our office. We just changed our office line. The new line, I don't know it offhand, unfortunately. But let me see if I can. I don't have it here. So we just changed our new office line yesterday, I believe. So I don't know the new line of offhand, but I believe you can also DM me, send a message to me on LinkedIn, Instagram, Facebook. We do get a lot of messages from Instagram as well, and we will be happy to reach out and help however we can. Yeah. And thank
Absolutely.
you guys for having me. I really enjoyed spending the evening with you, and
Absolutely.
I'll be happy to come back next time.
Thank you so
Yes.
much.
Yeah.
We appreciate it.
So,
All right.
Ibrahim, if people want to reach out to you, need a real estate agent, brokerage, I want to buy a new house, I want to buy a new investment property, I want to invest in real estate, I don't know how to go. These are the things, these are the services that you provide. How can people reach out to you?
Oh yeah. People can call me on 317-728-0213, or you can go to IB Realtors on Instagram, Facebook, WhatsApp. Just DM me and I'll respond to you, as quickly as possible. So, Ahmed, how can they reach out to you? You are a property manager. So it's like we have full package here today. We have CPA, we have real estate broker, we have a property manager. And the good news is we are all investors. So, if I don't know, I can call Tax Monarch. If So, or if I want to invest in, I need someone to manage my property, or I need anything concerning, you know resource on how to fix this, how to navigate with maintenance and everything. We have Azio Property right there, Ahmed. Okay, so Ahmed, anyway, how can they reach out to you?
Yes, we are open to new clients, and you can reach out to me on 317 79 uh sorry, I'm mixing the number up. 317 689 70 75. And you can always DM me. I'm on all the social media as well, and people DM me all the time on Facebook and on Instagram. And when I see that their question is going beyond what we can be chatting back and forth on, I get them on my phone and let's just talk, right? Let's talk. I'm happy to always answer your questions. So this will be the end of this episode, unfortunately. But guess what, guys? This is why we are doing it live, right? Because we want to answer your question, and we really appreciate everybody contribution this week. Please and please share this episode, subscribe to our YouTube channel. Share and share and share, because the information, you don't know how much you need to pay Alaja personally to get this kind of information off of her. We brought it to you live, so you don't want to just hold on to it. This is a video you need to go back and watch and watch and watch. And if you have any question, I believe the let me put our number once again on the screen. This is our email already, info@trycpallc, but let me put this
And
here.
you can also put Taiwo at TRACPLC. So that's our office line.
Okay. So this is their office line. The email is info at TRACPALLC. I don't want them to blow your personal. We your personal customer, and we are the only one that should have that direct link now.
Yes, I know.
So without further ado, Ibrahim, I think we are good to go, right?
Ahmed, it's all right. We like sharing. So yeah. She's knowledgeable, and we would like her to pass
Yes.
that same positive impact to all our brothers and sisters out there. So we don't mind. We share.
Abundant mind. Abundant mind.
Yeah.
All right.
Yeah,
Thank you, guys. We will see you guys next week.
Okay. Okay.